You've probably heard something in the news about the one big, beautiful bill. But while most of the headlines focus on politics, we're focused on what it means for you and your retirement. Now, this new law could have a huge impact on what you pay in taxes or what you get to keep. And there are a few planning windows that just opened up that may not stay open for long. So let's walk through exactly what changed and what you should be doing about it right now.
Welcome to another episode. Walter Storholt here alongside financial advisor Scott Dugan. And it's serious business today, Scott, as we have the big, beautiful bill to break down on today's show. And we're going to try and narrow the scope of this 800 plus page thing down to, I guess, just some of the financial stuff and not necessarily all the politics that went involved with this thing. But I'm looking forward to your takeaways on this.
Totally. And, this is very fresh. A lot of the experts that weigh in on these things. Like tomorrow, one of the top experts, Robert Keebler, one of the top CPAs in the country, we're doing a webinar with him to give him his breakdown on that. Some other things that are happening later in the month. So what the team and I did is we jumped in and looked at, hey, what do we know? Let's do some research. Let's boil this down into what are the things that would impact our clients the most, those folks that are, close to retirement or in retirement, and, how they really need to be thinking about it. Because I tell you, man, there's a lot of misconceptions, which we're going to do a whole episode on those myths. But yeah, we just want to talk about here's what we know today. And again, we've tried to be as accurate as possible. But like some of these things will still shake out and be fleshed out over the next coming weeks and months.
Excellent. Well, let's dive right on in. And I know one of the big headlines is that we are not going to see the sunsetting of the tax cuts, the lower tax brackets that we've had over the last several years. Those have been made permanent, but that's a big caveat, right?
Permanent for now. And, we've been talking about this, from 2018 through this year. That's where we were focused on our tax planning because we had historically low tax rates and we wanted to take advantage of those. And so now we knew that there's probably going to get extended, but now they're supposedly indefinite. So again, they were set to expire at the end of 2025. Now they've been made permanent, but in Washington, that just means no official sunset has been set in place.
Yeah, a very different definition of permanent than maybe everywhere else in the world that you would apply it to.
Yes. And so again, the takeaway there is now we know what our thresholds are. And, this is a great example. This shows us what our marginal rates look like. And that also are capital gains rates in this example. Again, this is also from Bob Keebler and his team. And so if you look at this, it's still that 22 and 24% brackets for a lot of people are going to be their window of opportunity when it comes to doing something like Roth conversions, post retirement. And so we still have a lot of headroom there that we want to take advantage of if it's right for our client situation. Kind of the takeaway from this, kind of the insight is if you're in peak retirement years, these lower brackets definitely create a continued window for Roth conversions, strategic withdrawals from different accounts, and tax bracket optimization. And so really what you need to be asking yourself is, are you taking full advantage of the current marginal tax brackets? Because our team sits down and looks at our client situation. We run preliminary numbers at the first of the year, and then we check those towards the end, Q4, and saying, hey, have we maximized the brackets? Do we need to take a little bit more out? Do we need to accelerate a few things? So again, these are only things that you can do if you're analyzing a tax return, and a tax return analysis is part of your financial planning scenario. So definitely ask yourself, are you taking full advantage of what we're presented with today?
And if you aren't taking advantage of some of these things that we've just talked about, as well as some of the other opportunities we're going to uncover in a couple of minutes here on today's episode, check the link in the description of today's show. Whether you're watching on YouTube or listening on your favorite audio podcasting app, we've got a link there where you can book a call with Scott's team and dive into the nitty and gritty of your situation, some of the opportunities available this year, next year, and into the future, and start putting together that solid financial plan. So it's a free consultation. Again, you can book that by clicking the link in the description of today's episode. So that was certainly a big headline, Scott, the fact that those are going to continue, those tax brackets from the last couple of years. I think maybe the second biggest thing from the bill for our audience, at least, is going to revolve around those standard deductions and a little increase on that side of things.
Definitely, they've made those permanent. The Big Beautiful Bill makes those higher deductions permanent, and definitely preserving simpler tax filing and larger tax-free income thresholds for a lot of people. The estimates that I've read is that only about 10% of the population is actually been able to itemize right now. So this will continue that for those people. So again, positive news. And again, the tax code is a set of rules. It's black and white. We can operate and navigate now that we know that we've really got, through 2028, is a lot of these things are going to be preserved, we think, until the end of 2028. So what we were looking at, if, pre Big Beautiful Bill, is that the single deduction would go to $8,000 and married finally drops to $16,000. And so that would have been a pretty big drop, in those deductions. Now, obviously, there would have, been able to itemize things like that. But now, what we do know, 2025 and beyond, again, made permanent, a lot of air quotes today, that single deduction would be $14,600. Married finally jointly is $29,200. And again, that is for people that are below 65. Now, if you're above 65, there's an additional standard deduction. If you're single, it's $1,550 added to the standard deduction. And married finally jointly, it's $3,100 total for that, again, stacked on top of that. So to say another way, a married couple, both 65 plus, gets $32,300, which constitutes the $29,200 standard deduction, plus the $3,100 over 65 deduction, and those added together to give you a little more wiggle room on your 1040. So again, simplifies the filing for most retirees, but a planning tip, you definitely want to reevaluate annually, especially if you're near itemizing thresholds. And obviously, we have a tax practice here at Elevated Retirement Group. We have Elevated Tax Group, and we run those calculations, whether it's standard deduction or itemization, to make sure which one is best for our clients. And I think that's very important as a takeaway, to be able to look at both of those.
As they say on the infomercials, but wait, there's more. And
there's still more.
And there's still more. We're going to put a pause. We'll come back to standard deductions and another little caveat to add on to that, but we'll take a breath and switch gears slightly for the next example here. And this is the SALT cap. And I know this is one that's going to apply, it sounds to me, Scott, at least like it's going to apply maybe really effectively and widely to some people and not much of an impact to other people. So this one might be a lot more difficult for people to understand how it's going to hit them.
And definitely, and we're going to hit the high points. I think we actually may do an entire.
We could do a whole episode on this, right?
Whole episode on this. Yeah. But right now, what we do know is the $10,000 cap on state and local tax deductions has been significantly raised, but not removed for everyone. So that's the key. So there is an expanded SALT deduction phase out. So you've got to be aware of the rules and limitations. Those phase outs begin at $500,000 adjusted gross income for an individual, and $1 million just gross income for married filing jointly. So that's when it begins to phase out and decrease. So now it's going to be fully phased out at $600,000 AGI for an individual and $1.2 million AGI for married filing jointly. So Walter, where this is going to come into action in this phase out is the folks that are in that $500,000 to $600,000 range. You've got to be very careful. You're going to have to make some decisions because of if you've got a large SALT deduction, it may not be beneficial to work those extra hours, work that extra day. So there's going to be some real delicate planning that's going to go into place for those high income earners that the SALT deduction, they're at risk of phasing that out. So again, itemizing may now be back on the table. But the question for everyone listening and watching is, was the old salt cap limiting your deduction? So you definitely want to look into that. And I know part of our process that we go through in the software that we use, we have a checklist we go through to see things we need to double check, look at things that may apply to your situation. And we can run different scenarios, pulling those pieces off and on to see how it affects that 1040. And basically, we're really looking at it, does it affect the check that you have to write to Uncle Sam?
Great point. And also worth mentioning, if folks want to go through that kind of tax analysis, again, click the link in the description of today's show to schedule a time to meet. And you can indeed start going under the hood and looking at the tax situation that you have in your portfolio and how it can be changed up, not just in regards to the salt cap, but all the things that we're talking about today and more. By the way, don't forget to stay tuned to the end of today's episode. Before we get to the finish, we're going to show you an example of exactly how a lot of these changes play into a prospective client's situation. And we'll show you the true differences between different earning amounts as well, to kind of just show you what are the tangible dollar differences that a couple might see as they go through some of these new tax bill changes. So we'll reveal that coming up in just a few minutes. But now we get back to that wait, there's more part of the standard deduction element. Senior citizens getting a little bit of a bonus, and this is pretty significant, Scott.
Yeah. And so, and I don't know if everyone likes the fact they call it a senior bonus deduction.
True.
But
yeah.
I
Maybe
wasn't in
charge. A better name.
charge of that. And so what the big hubbub is about is the new $6,000 per person deduction. So it's $12,000 if you're married, filing jointly. This applies to those that are 65 and over, but is income sensitive. What's that mean? It's means tested. It means there's a phase out range. So when do you start to lose that deduction? So it begins phasing out at $75,000 in modified adjusted gross income as an individual, or $150,000 modified adjusted gross income as a joint tax filer, so married filing jointly. So it begins to phase out at that 75 and 150. It's fully phased out at 175 and $250,000 modified adjusted gross income. So again, I won't get into the details too deeply, but the calculation, there's a 6% in that 75 to 175 and 150 to 250 calculation that we do to reduce that. But as for clarification on this, it does lower income, which may reduce tax on Social Security. It's important to understand this expires after 2028. And so this is probably one of the most significant pieces that's here. There was a lot of campaign promises, talked about no tax on Social Security. And we don't have time to go into how difficult that actually is to do from a political process. But the passing of this additional $12,000, that's what's going to allow some people to pay less money or pay nothing on their Social Security income. So it doesn't get rid of tax on Social Security, but it does give some people an advantage and be able to lower that. But again, the more money you make, and we've talked about this on many, many podcasts, it's not that they're necessarily going to increase tax rates, but they're going to means test or phase things out to these higher income earners. And that's where a majority of our clients are going to fall into those ranges, and we're going to have to work around that.
I was going to say, I've seen it as like 88% was one of the numbers I saw out there. Folks won't pay tax on their Social Security, but a lot of the people watching this show, Scott, might be in that 12%, and a lot of people that you work with. So it's still a reality for some folks. For sure.
It is. And to those numbers, I have not been able to find empirical data and sources to back that up.
Okay.
But
I do know these claims that's kind of spinning.
Yeah, some claims.
Okay.
And so, yes, promises were made. They did not change Social Security law, but they changed tax law to give people a benefit. Now, a vast majority of Social Security recipients don't pay any tax on their Social Security on the lower income side of things. So this is for people that are taking, maybe have pensions and Social Security, or they've got Social Security and they're taking distributions from their IRA or their 401k. That's where this is going to come into play, 25 through 2028.
Okay, very good. Let's move on to the next piece of the bill that kind of caught your interest, Scott. You've underlined and highlighted this one, Roth opportunities. We still have some good ones that are alive. So this is more about what didn't change, right?
Yeah. So no new restrictions on Roth conversions. There's been banter that they're going to take that away. The Roth window remains open for now. And it's definitely going to be ideal for clients that are, 59 and a half and above. Why? Because there's no 10% penalty to do that. So the things that you want to evaluate is you're going to want to know your brackets, your tax brackets that we talked about, that chart. I would tell you to save that, print that triangle chart off that we had earlier. Understand your IRMA thresholds, meaning your additional potential tax on your Part B and Part D of Medicare, based on your income levels, and look at, how does this affect your estate plan? Because this is my personal opinion or personal thoughts. We have made these tax cuts permanent for now. And what it does is opens a window of opportunity for people that it makes sense to do these types of conversions, these types of withdrawals. Does it fix the underlying fiscal problem that we have with unfunded liabilities of Social Security, Medicare, things like that? It does not. Do I still think we've got the possibility of higher tax rates in the future? I definitely believe that, because we are adding more deficit spending and more debt to the country. Now, the concept we're embarking on is that through growth, through expansion, that we get our way out of it, lower interest rates, become a stronger hub for business and capital from around the world. And so those are all great things. But if we don't make changes to the system and into our debt, then I do believe we're in line to have higher tax rates in the future, which, using our low tax rates today to move money from tax deferred to tax free, what you're doing is you're doing it at a time where we know tax rates are low, and taking advantage of that, because we think that in the future they're going to be higher. And just remember, when we tax defer things, we're not only deferring the taxes, but we're deferring the tax calculation. And what do I mean by that? It means you're taking a tax deduction now to put money into an IRA or a 401k. So you're taking that deduction today and deferring the tax, but you're deferring it to a time where the tax rates are unknown, because no one knows the future. So when you're looking at these Roth conversion opportunities, you really have to have a strong belief that tax rates are potentially going to be higher in the future, especially when you're at your peak retirement years, where you're being forced to take money out of your IRA through required minimum distributions. That's why people are still going to be considering Roth conversions as a window of opportunity to take advantage of.
Is your retirement strategy working as hard as you are? Get the answers you deserve with Elevated Retirement Group's information-packed toolkit. Inside, you'll get Scott's book, Exceptional Retirement, along with essential insights covering the 5 key areas of retirement planning, strategies to keep more of your hard-earned money, and how to choose your winning retirement team. Take control of your retirement today. Click the link in today's show description to claim your toolkit at no cost to you.
Should I do a Roth conversion is one of the big things that brings people through the door or gets them into a Zoom call with Scott and his team at Elevated Retirement Group, because it is such an important question for retirees to be asking. And so if that's on your mind, again, click the link in the description of today's show, schedule a time to visit with the team, and that could be your opening question and something that you'll start to dig into to see if that's right for you to do. And should you take advantage of doing that in the near future before some of these things, again, the permanent things expire and some of the sunset things come to place, come to fruition. We got to be aware of that timing on all of those things. So kind of a gift we've gotten here, Scott, with some of this flexibility and opportunity extending that window a little bit.
And I think it comes down to certainty of the rules we have to engage with.
Yeah.
So we now know that most likely through 2028, we know what our time frame looks like. And so I think it's very important not to squander these 4 tax returns. So it's 25, 6, 7, and 8. You've got 4 tax returns, 4 years to take advantage of these things. And so if you're not looking at these things, or if you're just, doing your taxes, oh, our CPA said this is what we owe, there's nothing we can do. I think that's probably an indicator it's time to get maybe a second opinion and really look at what can you do to improve your situation year by year, but ultimately throughout your retirement.
All great points. We still have a little bit more to get to here, Scott. Our business owners and anybody who's maybe involved in property, their ears have been kind of alerted and perked up here to some of the changes in this bill.
Yeah, and there's a lot that goes into this, but we'll just touch on it. Starting 2025, 100% of bonus depreciation for qualifying businesses expenses or rental purchases, 100% depreciatable in that year. That's going to be big. We're trying to get people to open businesses, move businesses, open plants, things like that. That is going to be important. And so it's definitely going to be a useful tool for exit or reinvestment planning for our business owner clients. And that's where you're definitely going to want your team to be coordinated. You want your financial planner, your CPA, tax planning expert, your estate planning attorney. You're going to want all those people on the same page to look at what are all the advantages to legally lower your tax bill with the current tax law that's on the books.
And I know we can't hit everything in this enormous bill, but to wrap up this portion of the program, give us a quick hits of some of the other things that caught your eye.
So other provisions worth noting, charitable giving. There's an above the line deduction now. So if you're single, it's $1,000 and $2,000 married, filing jointly. And so you don't have to itemize to do that. So again, it's above the line. So that's good. I think that'll help stimulate potentially more giving. The auto loan interest deduction. Don't get too excited. You're not going to be able to go buy a Ferrari and you deduct it all. It's going to be U.S. assembled cars purchased 2025 plus, and there is going to be a limit. What I've read is a $10,000 cap per year on the interest expense. But the way I look at that, business owners have purchased vehicles, through their business and got a good deduction. This is a way for retirees, especially, to deduct interest on their tax return, but it's also a way to help stimulate U.S.-based auto manufacturers. So that's going to be a big one. EV credits are going to end September 30th, 2025. That's happening. One that's being talked about, and actually one that was campaigned on, tips up to $25,000 being tax-free. Now, your employer is going to pay FICA, Medicare, things like that, but it's not going to be income taxable. And there are income thresholds on that. So if you've got, 2-person household, one person's high income earner, one, works in a tipping industry, they're going to put those two things together and phase that out. But for a lot of people, that first $25,000 tax free, and it says cash tips, but that is going to be through credit cards, things like that. They just don't want somebody giving you a car as a tip. Cash equivalents is what this is going to go towards. And
I like this one just for nothing else other than, like, I always feel bad tipping with the credit card because they're going to have to pay taxes on it versus not. And that cleans that up a little bit. Which is
absolutely.
Yeah.
Student loan and child tax credits, small changes, but may help heirs. We are trying to get the final detail on the count for children. A lot of if your clients, Tyler, one of our lead certified financial professionals here in the office, and definitely my right hand, they're expecting their first child this year. And it looks like you can open that account. The government puts in $1,000. The parents can put up to $5,000 in it. And we're thinking it's going to grow tax deferred. We just don't know what the taxation is or the acquisition or be able to tap into it looks like. But again, promising for people in that situation. But again, think multi-generational in a lot of these things, whether it's your kids or charity, is definitely going to be potentially be beneficial. So our closing thoughts: this bill didn't blow up the tax code. I'm sorry, we didn't, not Wile E. Coyote, Roadrunner, blow it up. But it did shift the terrain. And I think these small changes can create, big planning opportunities, or they can create risks. So you've got to be careful about that. And one of those things that, again, what we'll talk about, we'll give a couple examples, is what level of detail are you using or being shown to help you make good decisions? And I know in our office, we do a lot of tax analysis. We have unbelievable tax analysis software. And one of the things I prepared for today, and again, we'll just jump into it briefly, but this idea that this is not helping, this is only helping, billionaires and business owners, things like that. And so we ran two scenarios, and we ran at different income brackets, both 65-year-old couples, but one earning about $120,000 a year in income. All right, so here is a quick example, and it's really looking at pre and post Big Beautiful Bill 2024. That's basically with the Tax Cuts and Jobs Act, the current tax situation prior to the bill. So in this situation, we had George and Jane Jetson, taxable interest of $5,000. They're taking out $75,000 from their IRA, and they've got $40,000 in pensions and or annuities. And so looking at that, their total income is $120,000. Now, under the old tax situation, their deduction would be $32,300. That's the standard deduction. Their taxable income would be reduced to $87,700, meaning they'd owe about $10,600 in federal taxes. That puts them in the 12% marginal bracket, and their effective rate is 11.5. So that's the average they're paying. So again, total tax of about $10,000. Now, if we take that same couple, exact same example, and apply the new bonus deduction, which is $12,000, so that drops our taxable income down to $73,300. And the tax on that equals $8,319 versus that previous $10,600. Now, we're still in the same marginal bracket of 12%, but we have a slightly lower effective rate at 11.3. But really what it comes down to is your tax bill for the federal level is $8,319. So what's the difference? What was the effect of pre and post Big Beautiful Bill? That is a $1,741 decrease in federal taxes. So $1,741. And that equates to a 17% decrease in federal taxes. We chose these numbers of 120,000. One, they're below the phase outs. And this is pretty common from the families that we serve and take care of. We looked at across the board, the plans we put together, and this encapsulates, this is kind of the low end of it, but we have a lot of these clients that, about $10,000 a month is enough to make the world go round. Now, if we compare, so this is kind of an average income, looking out there. Now, if we compare that to someone that's higher income, or let's say maybe somebody's doing a Roth conversion in the year. And so we did the same side-by-side comparison. We just increased the overall income somewhat. And it's going to show you that when you get to these phase-out levels, that $12,000 bonus deduction just doesn't mean a lot to you from a dollars and cents standpoint. So again, we look at same taxable interest, IRA distribution is $75,000, and then $175,000 taxable pension annuities. Again, that can include Social Security. So our total income in this scenario is $255,000 in total income. Now, if you apply the old standard deduction, it would be $32,300. And what that gives us is a taxable income of $222,700 and a total tax bill at the federal level of $39,723. Now, you're in the 24% marginal bracket and at an effective tax rate of 17.8%. And that gives us a tax bill federally of $39,723. And so again, that's pre-Big Beautiful Bill. And yes, that's an unfortunate name to have to say over and over again, but that is legally what it's called. So I'm just going by the book. So if you look at that, well, what if we get that extra $12,000 deduction? Well, when we get that $12,000 deduction, again, standard deduction goes up to $34,700. So our taxable income would be $220,300. Now, again, we're phasing out a big chunk of this $12,000 bonus deduction. Our total tax is still up there at $38,756 compared to $39,723. So not a big difference, not a big needle mover. Same marginal bracket of 24, net effective rate of 17.6. So if you compare those total tax numbers between 39,723 and then post bill of 38,756, you're only seeing a $967 decrease in taxes. $967 is not a big deal. A little over 2% decrease for these higher income earners. So a couple things to take away from this. The higher your income, the less of an effect this is going to have. That's number one. That's who it's going to affect. Number two, we've got to take this into account for people that are doing Roth conversions and tax planning, because we've always been very sensitive to IRMA taxation, getting taxed on that Part B and Part D of your Medicare. Well, now we've got to factor in, are you phasing out that $12,000 bonus deduction? And is there a sweet spot in there? And again, this just came out. We're still running the numbers and building our models going forward, but it is something that's on our radar, and we will be managing to that especially our year-end tax planning for our clients. So again, this is going to affect a large number of the population in a positive way. The higher up you go on the ladder of income and assets, it's just not going to be that big of a needle mover for you. But that's what we're dealing with as of today.
It's a great breakdown, Scott, and putting it into that kind of hypothetical example, I think will drive it home for a lot of people to just kind of see these tangible differences that can be made with some of the changes that have been passed through, what it might mean to their lives as they watch today's video or listen to the podcast. So I find all of that really helpful. As always, we can cover a lot of ground here on the show, but we can't get into your specific situation. Mm-hmm. So if you'd like to go through the planning process, or at least have an initial discovery meeting to see if you'd be a good fit to work with an advisor like Scott Dugan, like his team at Elevated Retirement Group, just click the link in the description of today's show. You can schedule that time to meet at your convenience. Wherever you are, doesn't matter. Scott works with clients all across the country. So don't hesitate to reach out and have that conversation today. Scott, great breakdown on all of this. I know we'll cover some more myths related to and kind of busting some of those things related to this big, beautiful bill, and hit on a few other topics in our next episode. So I look forward to doing that with you.
A lot of material to cover over the next few months.
Thanks, everybody. We'll see you next time right back here on Your Retirement Elevated.
Are you on the path to retirement but feel uncertain about your direction? Don't let myths and misconceptions cloud your journey. Before stepping into a lengthy retirement, gain clarity and confidence with a complimentary financial review. Schedule a conversation with Scott Dugan. It's completely free. Just click the link in the description below or call us at 913-393-4724. Let's start a conversation about what's most important to you as you plan for a successful retirement.
This video has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this video is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt and Third Wheel Media LLC receive compensation for their assistance in preparing and hosting this video.